Something happened in Germany that should be front-page news everywhere, but somehow it's been buried under other headlines. For the first time in 88 years, nearly 9 decades, Volkswagen is closing a vehicle production facility inside Germany. Let me repeat that. Volkswagen, the symbol of German industrial might, the company that employed generations of German workers, the crown jewel of Europe's largest economy, is shutting down production at a German plant. The Dresden facility stops vehicle production in mid-December 2024. This is not a temporary pause, this is a closure. And if you think this is just about one factory or one company, you're missing the bigger picture. This is the beginning of Germany's industrial collapse. And it's happening for one simple reason: energy. I've been following European industrial policy and energy markets for years, and what I'm watching unfold right now is the predictable consequence of one of the worst strategic decisions in modern economic history. When Europe, and Germany in particular, cut itself off from cheap Russian natural gas, they destroyed the foundation of their industrial competitiveness. And now the bill is coming due. Let me walk you through what's happening, why it's happening, and why this is only going to get worse. Because once you understand the economics of energy-intensive manufacturing, you'll see why Germany's industrial base is doomed under current policies. First, let's establish what made Germany an industrial powerhouse. It wasn't just German engineering or educated workers or strong institutions. Those things matter, but they're not unique to Germany. Japan has excellent engineers. South Korea has excellent workers. Switzerland has strong institutions. What made Germany special was cheap, reliable energy. Specifically, cheap Russian natural gas delivered via pipeline. For decades, Russia supplied Germany with massive quantities of natural gas at very competitive prices. This energy fed Germany's chemical plants, steel mills, automotive factories, and manufacturing facilities. Germany's industrial model was built on this foundation. Energy-intensive industries, chemicals, metals, machinery, automotive, became the backbone of the German economy. These sectors don't just consume energy as an input. Energy is often the largest cost component. When you're producing steel or chemicals or aluminum, energy costs can be 30% to 50% of your total production costs. So when you have cheap energy, you have a massive competitive advantage. You can produce at lower costs than competitors who pay more for energy. You can export profitably. You can maintain high wages and strong labor protections because your cost structure supports it. This was the German economic miracle. High-value manufacturing, strong exports, trade surpluses, rising living standards, and it was all powered by cheap Russian gas flowing through pipelines like Nord Stream. Then came 2022. Russia invaded Ukraine. The West responded with sanctions. Germany decided to cut itself off from Russian energy. Nord Stream pipelines were sabotaged. Russian gas flows stopped. At the time, German politicians framed this as a necessary sacrifice. We'll find alternatives. We'll build LNG terminals. We'll accelerate renewable energy. It will be difficult, but we'll manage. Nearly 3 years later, here's the reality. German natural gas prices remain 3 to 4 times higher than they were during the Russian gas era. In 2021, before the conflict, German industry could buy natural gas for roughly 20 to 30 euros per megawatt hour. In 2024, prices fluctuate between 70 and 100 euros per megawatt hour. That's not a minor increase. That's a structural change that makes energy-intensive manufacturing economically unviable in Germany. LNG imports. Liquefied natural gas shipped by tanker from the US, Qatar, and other producers are much more expensive than pipeline gas. You have liquefaction costs, shipping costs, regasification costs. LNG can never be as cheap as pipeline gas directly from Russia, which is right next door. Renewable energy helps at the margins, but it can't power industrial baseload. Chemical plants and steel mills need continuous, reliable energy supply 24/7. Solar and wind are intermittent. You can't run a factory that operates 24/7 on energy that's only available when the sun shines and wind blows, so Germany is stuck. High energy costs are now structural, and high energy costs mean German industry is no longer competitive. Let's look at what's happening as a result. Volkswagen's Dresden closure is just the most visible example, but the carnage is much wider. Volkswagen announced they're planning to eliminate 35,000 jobs at the Volkswagen brand in Germany by the end of the decade. That's not jobs being moved or restructured, that's jobs being eliminated. The company reached an agreement with unions to avoid factory closures in other locations, but only by accepting massive workforce reductions and cost cuts. At other German plants, Volkswagen has already reduced working hours and shut down production lines for multiple days. The Zwickau plant, which builds electric vehicles, halted production for a week in October 2024. The Emden plant has seen similar temporary shutdowns. The official explanation is balancing supply with current market conditions. The real explanation is that demand is weak, costs are high, and the company can't maintain full production profitably. But Volkswagen is not unique. BASF, the massive German chemical giant, is moving production out of Germany. They're investing billions in new facilities in China. Why? Because energy costs in China are a fraction of what they are in Germany. BASF's CEO has been remarkably blunt about this. They've said explicitly that Germany is no longer competitive for energy-intensive chemical production. China has cheaper energy, cheaper labor, and a growing market. The math is simple. ThyssenKrupp, the steel manufacturer, is cutting capacity in Germany. Steel production is extraordinarily energy-intensive. When your energy costs triple or quadruple, you can't produce steel profitably. So ThyssenKrupp is downsizing, closing facilities, and moving what they can to lower-cost locations. Siemens, the industrial and technology conglomerate, is restructuring operations. They're not abandoning Germany entirely, but they're increasingly shifting production and investment to other countries. This is not just about individual companies making rational decisions. This is about the systematic deindustrialization of Germany. The foundation of German prosperity, energy-intensive manufacturing, is leaving, and the economic data reflects this. Germany's GDP contracted by 0.3% in Q3 2024. That's not growth slowing down. That's actual contraction. If Q4 also contracts, Germany enters technical recession. Industrial production in Germany is still below 2019 levels. 5 years later, German industry has not recovered to pre-pandemic output. Meanwhile, China's industrial production is up over 20% from 2019 levels. The US is also significantly higher. Germany is stuck. The trade surplus, long the pride of German economic policy, is shrinking. Germany is exporting less because German products are becoming less competitive. And politically, this is creating a crisis. Chancellor Scholz's government has approval ratings around 21%. That's historically low. The German public is watching living standards decline, unemployment rise, and the economic security they took for granted evaporate. Let me explain why this is permanent, not temporary. Some people think, well, once the Ukraine situation resolves, maybe Russian gas flows return and everything goes back to normal. That's not going to happen. First, the infrastructure has been destroyed. Nord Stream pipelines were sabotaged. Rebuilding that infrastructure would take years and billions of euros, and there's no political will to do it. Second, Russia has reoriented its energy exports to Asia. They've built pipelines to China. They're selling gas to India, to Turkey, to China. They're not desperate to sell to Europe anymore. Third, Europe has committed to renewable energy transition. They've spent hundreds of billions on wind, solar, and green infrastructure. Politically, they cannot reverse course now without admitting the entire strategy was a mistake. So Germany is stuck with expensive energy for the foreseeable future. And that means German industry will continue to leave. Where is it going? Two places mainly: China and the United States. China offers cheap energy, a massive domestic market, and a government that actively supports industrial development. When BASF builds a new chemical plant in China, they get cheap natural gas, streamlined permits, and access to 1.4 billion consumers. The United States offers cheaper energy than Germany. US natural gas prices are much lower due to domestic fracking production, plus the Inflation Reduction Act subsidies for clean energy and manufacturing. The US is actively competing for industrial investment, and they're winning. Germany, meanwhile, offers expensive energy, heavy regulation, and political uncertainty. Why would any rational company invest in new industrial capacity in Germany under these conditions? The human cost of this is enormous. Volkswagen's 35,000 job cuts are just the beginning. Multiply that across BASF, ThyssenKrupp, Siemens, and hundreds of smaller manufacturers, and you're talking about hundreds of thousands of jobs disappearing over the next 5 to 10 years. These aren't jobs that can be easily replaced with services or tech. A chemical plant worker or automotive assembly worker can't just retrain as a software engineer or consultant. And even if they could, Germany doesn't have a tech sector large enough to absorb displaced industrial workers. So what happens? Rising unemployment, increasing social spending to support unemployed workers, shrinking tax base as companies leave and jobs disappear, larger budget deficits, and political instability. We're already seeing the political consequences. The rise of AfD, Alternative for Germany, is directly linked to economic anxiety in regions where industry is declining. People vote for extremes when they feel the mainstream parties have failed them economically. And the mainstream parties have failed. The decision to cut off Russian gas was made without adequate planning for alternatives. The assumption was that market forces and renewable energy would solve the problem. But physics and economics don't care about political assumptions. Let me talk about what I'm watching to track how this unfolds. First, German industrial production data. If this continues declining or stays flat, it confirms the structural collapse thesis. Second, corporate relocation announcements. How many German companies announce new facilities in China, US, or other locations instead of Germany? That tells you where capital is flowing. Third, unemployment rates in industrial regions. Saxony, North Rhine-Westphalia, Baden-Württemberg, these are Germany's industrial heartlands. If unemployment rises there, it signals the job losses are accelerating. Fourth, government approval ratings and election results. If Scholz's coalition collapses or loses badly in upcoming elections, it reflects public rejection of current economic policies. Fifth, energy prices. If German natural gas and electricity prices don't come down significantly, nothing else matters. The cost structure won't support industry. So far, none of these indicators are improving. German industrial production is flat to declining. Companies are announcing relocations. Unemployment is rising in industrial regions. Government approval is terrible. Energy prices remain high. This is a slow-motion collapse, but it's a collapse nonetheless. Now, some European politicians talk about increasing green energy investment, subsidizing industry, or creating a European industrial policy, but these are band-aids on a structural problem. Subsidies can help at the margins, but they don't solve the fundamental issue. If it costs 3 times as much to produce chemicals in Germany as in China, subsidies would have to cover that entire gap to maintain competitiveness. That's fiscally impossible. Green energy investment is important long-term, but it doesn't solve the immediate problem. You can't run a steel mill on solar panels. You need baseload power generation. European industrial policy sounds good, but Europe doesn't have cheap energy to offer. Policy can't create energy out of thin air. The fundamental problem is physics and geography. Germany is located far from cheap energy sources. LNG is expensive, renewables are intermittent, nuclear power, which could provide cheap baseload power, is politically toxic in Germany after Fukushima. They shut down their nuclear plants. So Germany made a series of choices. Shut down nuclear, reject Russian gas, bet on renewables. Each choice seemed reasonable in isolation. Combined, they destroyed the foundation of industrial competitiveness, and this affects all of Europe, not just Germany. Germany is Europe's industrial center. If German industry collapses, it drags down the entire European economy. France, Italy, Netherlands, they all depend on trade with Germany and integration with German supply chains. European GDP growth is already anemic. The EU is projected to grow around 1% in 2025. Compare that to the US at 2% to 2.5% and China at 4% to 5%. Europe is falling behind. This is what happens when ideology overrides economics. The decision to cut off Russian energy was driven by moral and political considerations, not economic analysis. And while there are valid moral arguments about not funding Russia's government, the economic consequences were predictable and are now unavoidable. You cannot maintain energy-intensive industry without cheap, reliable energy. This is not a political statement, it's thermodynamics and economics. Let me be clear about my own perspective. I'm not making a political or moral judgment about whether Europe should or shouldn't have cut off Russian energy. Reasonable people can disagree about that decision. What I am saying is that the economic consequences of that decision are real, severe, and permanent under current policies. German industry is collapsing because the cost structure no longer supports it. This will continue until either energy costs come down dramatically or Germany accepts it's no longer an industrial power. I've personally reduced my exposure to European stocks and European assets. The structural problems are too deep, and the political will to fix them doesn't exist. This is not temporary cyclical weakness. This is permanent relative decline. But again, this is what I'm doing based on my own analysis and risk tolerance. I am not a financial advisor. This is not investment advice. Everyone's situation is different. You should do your own research and consult with licensed professionals before making any financial decisions. What I am saying is this: pay attention to Europe's industrial data. Watch where companies are relocating. Watch German economic performance. These are indicators of a major economic restructuring happening in real time. Volkswagen closing a factory after 88 years is not just a corporate decision, it's a symbol of Germany's industrial decline, and that decline will continue because the economic fundamentals don't support energy-intensive manufacturing at European energy prices. The German economic miracle was built on cheap Russian energy. That's over, and no amount of political rhetoric or green subsidies will change the thermodynamics of industrial production. Stay informed, watch the data, and recognize that Europe's economic model is fundamentally broken under current energy conditions.